Economists are warning of another 50 basis point interest rate hike as the South African Reserve Bank Monetary Committee prepares to meet this week. The expected increase would further hurt consumers' pockets as the country is battling at the moment high fuel and food prices. Let's talk about the forecast with Economist Isaah Mhlanga. Good to have you on the program as always, Isaah. So 50 basis points is the figure that's been thrown around over the last few weeks. In fact, I believe Governor Lesotho also hinted at that in a previous speaking engagement. Is that as high as you think we'll go?
Look, we don't expect this to be the peak. If you look at market expectations, currently they price in at 5.63% by the end of the year. So that's a further 88 basis points from where we are from 4.75% if you look at the repo rate, which means we are likely to see a cumulative 100 basis point increase before year end. But for this particular meeting, it's a 50 basis point that is a market consensus. And
is there room to maneuver downward, say 25 basis points?
Indeed, it's quite a possibility, but if you look in terms of our inflation dynamics, PPI have risen quite aggressively. If you look at the May print, there was something like 14.7% on a year-on-year basis. And that signals that producers are experiencing a significant increase in their cost base, which they're likely to pass on to consumers. The last print of the CPI in May was 6.5%. And we have seen over the last couple of months, CPI surprising on the upside. Market consensus is of about just over 7% for the June print, which means it's increasingly becoming way out of the SARB's target, which would prompt the SARB to respond at least much more aggressively over the short term. And if you also look at what other central banks have been experiencing, inflation has been surprising on the upside. Our own inflation expectations have been rising. And that is what the SARB is going to be concerned about. So I doubt they will do 25, much more likely a 50 basis point before they go back to 25 basis points.
Two things then that I'd like to pick up on in the simplest language. How would raising rates now by 50 basis points counter inflation in very real terms that everyone can understand?
In simple basis, raising interest rates reduces demand. It also changes market participants' inflation expectations. And when inflation expectations change in a downward direction, actually inflation tends to follow. That's how monetary policy influences inflation.
You mentioned the global trends around rates and inflation management or targeting, right? But is there appetite, I wonder, among the Monetary Policy Committee to swim against the tide at all?
Look, it's quite difficult. They are faced with a very difficult decision to make. On the one side, the cost of products or of living has been rising, which is what we call inflation. And their mandate is to control that inflation. On the other hand, hiking interest rates increase the cost of capital, might even push the economy into recession if you look at the US, for instance, which is also negative. But either way, monetary policy authorities will be blamed if they don't do anything. They will also be blamed if they do too much. So that's the balancing that they need to make. But in the South African case, we also have to understand that to preserve the buying power of money is actually beneficial for the poor. It's actually beneficial for those that are receiving social grants because it means those social grants can buy more goods. If we have continuously rising inflation, it means those social grants are going to buy less goods, which is going to be bad for them. So that's why it's quite important to control this inflation. For those that have mortgage bonds or vehicle financing, yes, they will have to pay more in terms of servicing that debt. But that is not the largest constituents that we need to protect. We need to protect the most vulnerable that depend on the state by making sure that the little they get from the state can buy more goods for their consumption.
Would we still, though, if we go with this 50 basis points now and get perhaps to a cumulative 100 basis points by year end, would we still be able to classify ours as moderate rates?
Indeed, we are actually moderate. If you compare with other emerging markets, they started hiking interest rates already in 2021. We were not. But even when we started hiking rates, our rate hikes were much more moderate. We have seen increases of interest rates of 75 basis points, of 100 basis points and above in other emerging markets. We have not yet seen that in our case. So the South has been quite modest in the response to inflation, primarily also because our inflation is not as aggressive as what we see in the rest of the world. But anyone that comes and say they have been too aggressive, they're simply not looking at what's happening in other countries where we are seeing central banks hiking much more aggressively. In my view, they have been quite careful to manage or to balance the needs of the economy while they're trying to control inflation. And remember, the interest rate increases affect the economy over a period of 18 to 24 months' time. So we will see the impact of the interest rate increases over time, not necessarily immediately, which is why they have taken a much more moderate approach to responding to inflation.
Economist Isaah Mhlanga, good to speak to you as always. Thank you.